The IMF is a multilateral organization that was created during World War II to help support currencies and trade flows after the war. What is the International Monetary Fund? The International Monetary Fund, IMF, was conceived in 1944 to secure international monetary cooperation, stabilize currency exchange rates, and expand global liquidity, access to hard currencies. The World War II allies and other cooperating countries set up the multilateral organization to help support currencies and trade flows after the war. What does the IMF do? The IMF's primary purpose is to ensure the stability of the international monetary system, the system of exchange rates and international payments that enables countries, and their citizens, to transact with each other. The IMF pursues its mission in the following three fundamental ways. Surveillance. A formal system of review monitors the financial and economic policies of member countries. The review system also offers both macroeconomic and financial policy advice. Capacity development. Practical support and training is directed mainly at low and middle-income countries to help them improve their economies. Lending. The fund makes loans to member countries struggling to meet their international obligations. Sometimes offered as a bailout, financial assistance is provided in return for implementing specific IMF conditions designed to return stability to government finances and to restore growth. Known as structural adjustments, IMF conditions have included balancing the budget, ending state subsidies, privatizing state enterprises, liberalizing trade and currency policies, and removing barriers to foreign investment and capital flows. Has the IMF's mission changed? Since October 2019, the IMF has been led by Managing Director Kristalina Georgieva, a native of Bulgaria. The fund's mandate was updated in 2012 to include all macroeconomic and financial sector issues that bear on global stability. The IMF's expanded mission incorporates the following objectives: fostering global monetary cooperation, securing financial stability, facilitating international trade, promoting high employment and sustainable economic growth, reducing poverty around the world. Does the IMF affect my daily life? The answer to this question depends on your address. If you live in the United States, the United Kingdom, or Germany, for example, the IMF is mostly invisible in your daily life because your country's economy is generally healthy. In contrast, the IMF significantly impacts the daily lives of the citizens of Ukraine, the Gambia, and Liberia, among others, because it is managing loans to these countries and is working to assist them in improving their struggling economies. Does the IMF affect the markets? The IMF affects the markets in that its programs are designed to head off economic instability, such as the sovereign debt crises that affected Greece, Portugal, Ireland, and Iceland starting in 2010. IMF actions to develop and support healthy economies around the world contribute to stable and healthy markets. What organizations are similar to the IMF? Also known as the Fund, the IMF is one of a group of international economic organizations including the following, among many others: the World Bank, the World Trade Organization, WTO, the Organization for Economic Cooperation and Development, OECD, the World Economic Forum, WEF. How are the IMF and the World Bank connected? Both institutions were founded at the Bretton Woods Conference, and they have complementary missions. The World Bank seeks to reduce poverty and increase shared prosperity in developing countries, while the IMF stabilizes the international monetary system and monitors the world's currencies. The World Bank provides financing, policy advice, and technical assistance to governments and provides programs to strengthen the private sector in developing countries. The IMF monitors the economy both globally and in member countries, lends to countries facing balance of payments difficulties, and offers practical help to members. Countries must first join the IMF to be eligible to join the World Bank. Who created the IMF? The twin institutions of the IMF and the World Bank were born on July 1, 1944, as World War II raged in Europe and the Pacific. Delegates from 44 nations came together in the United States at the secluded Mount Washington Hotel in Bretton Woods, New Hampshire. Their purpose was to agree on a system of economic order and international financial cooperation, with the joint aims of helping countries recover from the devastation of the war and fostering long-term global growth. Formerly known as the United Nations Monetary and Financial Conference, this gathering is universally referred to as either Bretton Woods or the Bretton Woods Conference. The international delegates also were motivated by more than the devastation caused by World War II. They wanted to prevent a rehash of the currency warfare that helped trigger the Great Depression in 1929. Worldwide economic officials, including Henry Morgenthau Jr. and John Maynard Keynes, sought to create new institutions that would encourage sustainable economic growth, promote higher standards of living, and reduce poverty. As one move toward introducing currency stability, the 44 founding signatory countries were required to peg their currencies to the US dollar, which at the time was backed by the gold standard. The United States, assisted by the United Kingdom, developed the initial plans for the IMF. Additional active participants at Bretton Woods included Mexico, Chile, Brazil, Russia, Belgium, the Netherlands, the former Czechoslovakia, Poland, Canada, China, and India. Who funds the IMF? The IMF functions as a co-op that is funded by, governed by, and accountable to its 190 member countries, of the world's total 195 countries. The U.S. is the largest contributor to and shareholder in the fund. The Treasury Department leads U.S. engagement in the IMF, with the Secretary of the Treasury serving as the U.S. governor to the IMF. The U.S. Executive Director of the IMF is one of 24 directors who exercise voting rights over the strategic direction of the institution. Based in Washington, D.C., the IMF receives funds, called quota subscriptions, from its 190 member nations. Members pay according to the size of their economy, with voting rights based on each member's quota. Special drawing rights, SDRs, are the IMF's units of account, and the SDR is valued based on a basket of 5 currencies: the US dollar, the euro, the Japanese yen, the Chinese RMB or yuan, and the British pound sterling. The IMF manages an allocation of about US $650 billion. Does the IMF have critics? Because its loans or bailouts come with various conditions, the IMF is vulnerable to criticisms from two camps: those who think its loan conditions are too tough and those who say those same conditions are too weak. IMF critics have arisen most noticeably among the Global South and other non-Western countries and cultures. During the late 1990s, critic Walden Bello focused on the IMF's and World Bank's programs of structural adjustment. Even more than 20 years later, the issues Bello raised remain relevant, particularly during times of international economic distress such as the Great Recession, 2008 to 2009, and the COVID-19 global pandemic. In his book Globalization and Its Discontents, Nobel Prize-winning economist Joseph Stiglitz labeled the fund a culprit in the failed development policies instituted in some of the world's poorest countries. He argued that economic reforms such as fiscal austerity, high interest rates, trade liberalization, privatization, and open capital markets have often been counterproductive for borrower economies and devastating for local populations. These economic reforms also have been called overly ambitious and intrusive. Finally, some have asserted that IMF interventions can end up increasing poverty, widening economic inequality, and even creating dependency. Is the IMF working on today's global problems? In addition to implementing an expanded mandate in 2012, the IMF has programs that address the financial and economic aspects of the following international challenges: climate change, sovereign debt issues, income inequality, gender economic equality, domestic violence, economic effects of automation, COVID-19 and public health in general. The IMF has also become involved in developments surrounding crypto assets and the growing crypto ecosystem. Many crypto organizations lack strong operational, governance, and risk practices. As crypto assets become more mainstream, the potential implications for the wider economy are likely to increase. The International Monetary Fund, IMF, is an international organization that promotes global economic growth and financial stability. It encourages international trade and reduces poverty. You should also know that the body, IMF, secures international monetary cooperation, stabilizes currency exchange rates, and expands international liquidity, access to hard currencies. Its role in shaping the world economy is enormous. Therefore, we will be looking at the role of the International Monetary Fund role, its structure, members, and the history of this organization. The International Monetary Fund, IMF, was established at the Bretton Woods Conference in 1944. Its goal was to rebuild Europe following World War II. The conference also established a modified gold standard to aid countries in maintaining their currency's value. The planners intended to stay away from the trade barriers and high interest rates that contributed to the Great Depression. This downturn resulted in massive physical and economic ruin in Europe, as well as the Great Depression, which wreaked havoc on both Europe and the United States. These events sparked a desire to develop a new monetary system that would stabilize currency exchange rates without relying solely on gold as a reserve currency. After the Bretton Woods system disintegrated in the 1970s, the IMF pushed for a floating exchange rate system, thereby making market forces decide the value of currencies in relation to one another. Members of International Monetary Fund. The IMF currently has 189 member nations, each of which has a proportional representation on the executive board based on its financial importance. Anguilla, Aruba, Barbados, Cabo Verde, Curacao, Hong Kong, Macau, Montserrat, Netherlands Antilles, Saint Martin, and Timor-Leste are among the IMF's 11 non-sovereign members. The Board of Governors sits at the apex of the organization's hierarchy. The IMF's day-to-day operations are managed by a 24-member executive board that represents the whole membership, and it is also assisted by IMF personnel. The managing director is the IMF's chief of staff and the executive board's chairman. He is aided by 4 deputy managing directors. Ms. Kristalina Georgieva, from Bulgaria, is managing director and chairman of the executive board from October 1, 2019. She is the chief of the IMF's 2,700 employees from 147 countries. She supervises the work of 4 deputy managing directors. Kristalina is also the chair of the executive board, which has a total of 24 members. The IMF governance structure starts with the governing board, which establishes policy and direction for the organization. Its members are the finance ministers or central bank leaders of the member countries. They meet each year in conjunction with the World Bank. These committees examine and give recommendations on the international monetary system. The IMF plays the role of examining and evaluating the economies of all of its members. As a result, it has a deeper understanding of the world economy than any other institution. The International Monetary Fund's objective is to promote global economic growth and financial stability as well as international commerce and poverty reduction. Through its capacity-building programs, the IMF provides member nations with technical support, training, and policy advice. These programs include training in data collection and analysis, which feed into the IMF's project of monitoring national and global economies. These capacity-building or development initiatives are focused on the IMF's core areas of competence, which include anything from taxation to central bank operations to macroeconomic data reporting. Cross-cutting concerns such as income inequality, gender equality, corruption, and climate change are also addressed through such training. The IMF makes loans to countries that are experiencing economic distress to prevent or mitigate financial crises. This also includes emergency loans. The aim is to help them rebuild their international reserves, stabilize their currencies, to continue paying for imports, and restore conditions for strong economic growth, while correcting underlying problems. The International Monetary Fund, IMF, keeps a close eye on the international monetary system and global economic trends, in order to identify risks and make policy recommendations for growth and financial stability. The fund also conducts a regular health check of its 190 member countries' economic and financial policies. In addition, the IMF identifies potential threats to its member countries' economic stability and advises their governments on potential policy changes. The International Monetary Fund, IMF, helps to keep the international monetary system stable and keeps track of the world's currencies. The IMF also monitors the global economy and the economies of its members, lends to countries with balance of payments problems, and provides practical assistance to its members. While the World Bank Group collaborates with developing countries to alleviate poverty, increase shared prosperity, and promote long-term development. Other facts about International Monetary Fund. 1. The amount available for lending is $1 trillion. 376 recipient countries of emergency pandemic financing. $303 million for technical advice, training, and learning. The International Monetary Fund has played a vital role in shaping the economy of many nations. The impact of IMF loans has been a hot topic of discussion. Opponents of the IMF believe that the loans allow members to engage in risky domestic economic policies, knowing that the IMF will bail them out if necessary. Critics claim that the safety net delays important reforms and encourages long-term dependency. Opponents further claim that the IMF bails out foreign lenders that have made poor loans, encouraging them to approve riskier international ventures in the future. However, the role of IMF cannot be denied in the areas of reducing the poverty nature of its members, and the various programs it organizes for its members, as well as restore economic growth in their various nations. Please, if you love this article, leave us a comment. Thank you for watching this video.